Oh, right. Today is Thursday, September 15th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. Before we start, 3 notes. Note number 1, this show is going to be a little shorter than usual. We're going to skip a lot of parts. And the reason is yours truly had something important to do today, so I'm recording this a little too late. But rest assured, by short and sweet, I mean like an hour kind of video. You see, this channel is not for the faint of heart. A lot of you say, hey, Maverick, your videos are too long. I can't watch all of it. Who's texting me right now? Anyways, you got complaints that the show is too long. You got ADHD, we'll take your f***ing medicine. But note number 2, yesterday we talked about the railroad strike that was looming. And the good news is we got a tentative deal. So for now, at least, crisis averted. We'll see what happens, but for now, we have a tentative deal. Note number 3, yesterday I might have mispronounced something, as I usually do, and I said fried instead of freight, and a lot of people got upset. But you know what? It is fright season. Halloween is around the corner. But you know what's coming before Halloween? That's going to cause a lot of fright? How about quad witching? Oh yeah, lots of action is due tomorrow. So let's not waste any more time, and here it is, in focus tonight. Quad witching, baby. They're going to go up and down, up and down, up and down, and shake everybody out. At least this is what they're planning to do. Whether they're going to be successful or not, that's a different story. Who's they, by the way? It's the dealer. We'll talk about that in a second, but so far this has been a really horrific bear market because the Nasdaq 100 stretch under the 200 days moving average is the longest in more than a decade. Now, what does that say? Number 1, it says a severe recession is coming. And you might have heard the news from FedEx after hours. We'll talk about that in another video. But it also says that we're not going to have the V-shaped recovery after this bear market is over. It's going to be a long, grinding, boring, stagnant kind of a crawl out of the bear market. And this will shake off a lot of market participants who are active right now. And perhaps among those market participants about to be shaken off is Tesla witch Mama Cathie Wood, because she went on a dip buying spree. You see, after the CPI disaster, when the stock market went down, Mama Cathie Wood saw that as an opportunity, a generational buying opportunity, and she scooped a bunch of stocks. Among them is Roku. She bought 27 stocks across 8 exchange-traded funds. But the largest one was Roku, and it appears that Mama Cathie Wood scored, at least for now. We'll see what happens with the stock tomorrow, but guess who followed Mama Cathie in the buying spree? The answer is, how about you, baby? The retail mom and pops. We bought about $2 billion worth of dip after the CPI crash. Individuals flocked to many of their favorite assets, including the Spider 500 and Apple, as they plowed more than $2 billion into the market in the year's second largest day of retail net flows. And this is according to Vanda Research. Even with the flurry of dip buying, which has been the calling card for small traders, there were many signs of weakening trend in demand. Multiple capitulation indicators are now flashing a warning sign. And this is according to Vanda Research analyst Marco Laccini. That means the likelihood of retail capitulation increases significantly near term should equities retest this year's June lows. So what are they saying here? They're saying the dip buyers are premature. They're about to be flushed down again. And the real capitulation happens if the June bottom is retested and fails. Retail investors' demand for U.S. stocks was proportional to the size of the market slide, Vanda said, with SPY drawing $395 million in mom-and-pop money for the biggest flood of one-day buying since July 2021. Whoops. The demand contrasts with professional investors broadly pulling money from the ETF. So smart money out, dumb money in, as nearly $6 billion left the fund Tuesday, which was the largest single-day decrease since April. The retail cohort also snapped up roughly $100 million worth of Apple and AMD shares, while Tesla and a pair of ETFs that are tied to the Nasdaq 100 rounded out the 6 most bought assets, according to Vanda. The dip buying, or buy the dip, mentality came as the iPhone maker sank 5.9% in its worst days since September 2020. Fidelity users were active on Wednesday before the U.S. stock market opened, buying shares of Apple, Nvidia, and Amazon. Buy orders for the 3 stocks outpaced those to sell shares at more than 3-to-1 ratios, with net buying in line with what's been seen during similar market routes this year. Signs are pointing to a further drop in purchases over the coming week. Retail inflows have been stuck on a downward trend over the longer term, as the average individual trader sits on more than 25% losses this year. Wow. Those losses mean the risk of capitulation has been mounting. However, that might be good for the market, according to Vanda. The capitulation of retail investors is likely to draw meaningful buying from institutions, opening a door for a more sustainable rebound. So a lot of you ask me, hey Maverick, when bottom? When bounce, right? You want to know when bottom? It's when you lose all your money. That's when bottom. When the retail crowd starts saying, you know what, the stock market is rigged, it's a sham, we lost all of our money. Let's go back to McDonald's. That's when the bottom happens. And of course, the smart money, the oligarchs, the predators, at that time, they buy the dip for real. But tomorrow, we have an important phenomenon coming that could move the market significantly to the upside or to the downside. And this event is quad witching. What does that mean? Options expiration across the ETFs, individual stocks, and the indices. After the market close, we have at least $1.7 trillion worth of options about to expire for the SPX. And then we have about $500 billion in single stock bets that are about to expire. And folks, this upcoming quad witching that's about to happen tomorrow already left a significant mark on the stock market. What are we talking about? Well, you see, after the CPI came out, the market took a massive dump, a massive puke. What was the reason behind the massive dump? How about the mechanical reason of options expiration? The headline reads, at $3.2 trillion. Options expiration seen worsening post-CPI rout. What are they talking about? Here it is. Well, before I do that, a little background for you. The assumption was, before we headed into this week, the CPI will come out cool, the dollar goes down, stocks will blast higher. So the dealer was prepared for this outcome. They were prepared to buy stocks. They've been buying stocks as a result of the gamma squeeze. Then when the opposite took place, all of a sudden they had to scramble and react the other way. And this is known as short gamma, meaning instead of the market maker, the dealer, buying stocks, because a lot of folks are buying call options out of the money, now the dealer has to pay attention to the put options instead, those who are holding put options with tomorrow's expiration. With those puts contracts expiring Friday, the activity of dealers turned more sensitive to the movement in the cash market. After the S&P 500 fell below 4,000, an area that harbors one of the highest open interest to roll out. Remember when we talked about the importance of open interest? Well, after 4,000 was breached, selling intensified. Steve Susnick, who's a chief strategist at Interactive Brokers, explains, once we broke through there, all hell broke loose. I have not been one of those to make too much hay about these expirations, but lately they really have become significant. Why? Because the entire stock market is becoming a casino. Nobody buys stocks anymore. It's all about options. Anyhow, it is the latest example of a controversial narrative that suggests that stocks effectively became a derivative of its own derivative, one that upends the traditional relationship between options and their underlying assets. At 8 a.m. Tuesday, dealer gamma was flat. This is the calm before the storm, the CPI, meaning they did not need to do much hedging. We're talking about the dealer right now. However, after the data on August's consumer price index hit the wire at 8:30 a.m., the S&P 500 futures tumbled almost 3% in a matter of minutes. Instantly, dealer positioning flipped to a dynamic known as short gamma. Meaning market makers had to trade with the prevailing trend, in this case selling stocks when they fall. And here it is unclear if the event known as OPX will fuel fresh fireworks on Friday this time around. About $3.2 trillion of options are set to expire, obliging holders to either roll over existing positions or start new ones. The tally includes more than $2 billion of the S&P 500 linked contracts and $505 billion of derivatives across single stocks scheduled to run out. The good news is that there was a little sense of panic during the S&P 500's $1.5 trillion rout on Tuesday. And this is according to Amy Wu Silverman, an equity derivative strategist at RBC Capital Markets. Stock trading volume was subdued, and the analyst did not see many new positions initiated in the derivatives market. Now, what does that mean? It means hedging activity from options dealers is likely to subside accordingly after Friday's event. Now, remember, the dealer wants the majority of call options and put options holders to lose money. So we're going to identify the points of maximum pain in a minute, but there is another phenomenon that is exacerbating the volatility in the stock market. It's not just gamma. It's not just options. It is the levered ETFs. You know, like the SQQs, on the long side, the TQQs. You guys love those. They happen to be really, really dangerous because they reset every single day. So the SQQs, for example, reacts 3 times what the Qs actually does in a single day. For example, if the Qs goes down by 1%, the SQQs goes down by 3%, but the next day it resets. And a lot of you, I don't know why, you guys trade options in these. Do you know how dangerous this really is? If your timing is not immaculate, you got a 99% chance of losing money trading options on these ETFs. But anyhow, the headline reads, leveraged ETFs added to stock chaos with $15.5 billion worth of selling. What are they talking about? Here it is. In Tuesday's tumultuous trading session was a pattern market watchers have seen time and time again this year. A bad day for stocks gets worse right around the close. Suspicions is growing that a breed of complex but increasingly popular ETF may be helping fuel the trend. With the main equity gauges all down heavily on the day, leveraged ETFs, which use options to amplify returns, usually of major indexes, added around $15.5 billion of selling pressure to the rout, and this is according to Nomura. It is likely a big reason why stocks took another dip in the last 30 minutes to close out a particular brutal trading session. While the propensity of options to lash the very stocks on which they're based has become a fact of life on Wall Street, doubts have remained about the capacity of leveraged vehicles to do the same. Yet trading volumes across these complex products have been historically high all year. Certain perks, such as in May and June, corresponded with instances of stocks extending their moves near the end of the session. It is absolutely real, said Charlie McElliott, a cross-asset strategist at Nomura, referring to the ability of leveraged ETFs to spur broader moves across the equity ecosystem, thanks to their balancing moves. What he means here is, by the end of the day, these leveraged indices have to reset, so a lot of rebalancing happens, and that tends to exacerbate the moves by the end of the day. He puts the boom in such products down to retail investors looking for big wins. Day traders remain drunk on high intraday volume and continue to actively seek out large price swings. I mean, folks, it is a dangerous phenomenon. When I talk to investors these days, and I say, hey, in a single year, you'll make 13% return, for example, or 16% return. They come back at me and say, that's boring. 16% in a year? I want to make 300, 400% in a single trade. So we have an epidemic of gambling. The risk with options and these leveraged indices, you can lose a lot of money if you're wrong and if your timing is not pristine. Now let's talk about the points of maximum pain, because I talked about 3,900 in the SPX being an important point, and it was a slugfest at the end of the day. You might have noticed that. The sellers got us below 3,900. And then, mysteriously, the plunge came out. We closed slightly above 3,900. So we know this is an important point, and it will become even more important in tomorrow's session. So now I'm hoping and praying that the majority of you will understand what I'm about to say here, because every time I try to teach something, I end up screwing up, and I create more confusion than understanding. And that's really disappointing. So I'm hoping this time around I will make sense. Let's give it a shot. Here's the options grid for the SPX, the S&P 500 cash index, for tomorrow's expiration. Now remember, what is the open interest? The open interest is the amount of bets that are placed right now on a single strike. So when we look at the 3,900, for example, the open interest is around 40,000. So we have 40,000 bets right now open that if the SPX closes above 3,900 for the day tomorrow, these folks will buy the SPX at 3,900. Unless, of course, they close these contracts before the end of the day or they roll out to another expiration date. Now, the point of the highest open interest that is closer to the price right now is the point of maximum pain. In other words, let's look at it from the dealer's perspective, the one who sold these 3,900 contracts, be it calls or puts. What happens if the SPX, in this case for calls, closes above 3,900 tomorrow? The answer is the dealer has to buy shares of the SPX at the market price at the time. So if the SPX is trading at 4,000 tomorrow by the close, the dealer has to buy the SPX shares at 4,000 and deliver them to those holding the 3,900 strike. So they're going to lose money. So what is the dealer looking for? They want these people to lose money, and they can do that by manipulating the SPX to close at 3,900 by the end of the day or below. And this will ensure that all of these open interest bets will expire worthless. Likewise, when we look at puts, what is the point of the highest open interest right now and the closest to the money? The answer is 3,900, because we have about 60,000 bets, 60,000 open contracts for the 3,900 puts. Now notice that the number of open interest for puts at the 3,900 strike outnumbers the number of open interest of calls at 3,900. What does that mean? The bias is to the downside. Now, what happens if the SPX closes the day below 3,900? Those who did not close their put options contracts at 3,900, well, they have to short the SPX at 3,900 after the close. Now, a lot of traders don't like that. They don't want to short the SPX. They're just trying to make some money here from trading these contracts. So a lot of folks will close their contracts or roll to another expiration date. But the dealer cannot assume that, because the risk for the dealer is, if the SPX closes below 3,900 tomorrow, is to buy shares of the SPX at the price of 3,900. Now let's say the SPX closes the day at 3,800. Now the dealer is losing money because they have to buy at 3,900. So again, put yourself in the shoes of the dealer. The point of maximum pain is to close the SPX exactly at 3,900. That way you ensure that the majority of call options holders and the majority of put options holders end up losing their money. Their contracts will end up expiring worthless, and hence 3,900 is the point of maximum pain. It's the point where the dealer wants to close the market tomorrow. Now, they can do that by having the market flat all day, but that's not possible because we have other forces buying and selling. So put yourself in the shoes of the dealer. How can you close the SPX exactly at 3,900 and inflict maximum pain on both call options and put options holders? Well, one way you can do that is you pump the tape in the morning, you create a rally in the morning, and then you flush the market midday only to push it higher by the close. And you try to close as close as you can get to 3,900. Now, why would you do that as the dealer? Here's why. When the market opens up gapping higher, or we see a rally right off the gate in the morning, a lot of these call options holders are going to book their profits. They're going to close these contracts or roll to another expiration date. Meanwhile, a lot of the put options holders at the 3,900 strike will say, you know what, it appears that the market is rallying right now and my contracts will expire worthless. So they end up bailing out, they call it a day, and they go to the beach. And then the market maker flushes the tape down, and those who are still holding calls and they were too greedy not to close, they panic and they start closing to book whatever profits, whatever losses they got. And then those holding the 3,900 puts, at that time, guess what? The value of their options deteriorated dramatically because the time value decreases as we get closer to the expiration. So they close whatever puts they got, whatever profits they got, whatever losses they got. And guess what happens? At that time, the dealer decides to buy shares of the SPX below 3,900. So when they run the tape higher again by the end of the day, if they close above 3,900, whoever left holding these contracts, in this case the calls, their contracts will expire in the money, meaning the dealer has to deliver shares of the SPX to them at 3,900. Well, guess what? They bought them below that, so the dealer is now making profits. Another way the dealer can achieve the same objective, and this is what will likely happen in tomorrow's session, is to flush the market down right off the gate in the morning. A gap down, a sell-off right off the gate, it doesn't matter. When that happens and the SPX is trading below 3,900, the put options holders who are now making profits because their contracts are in the money and they don't want to short the SPX at 3,900, well, they book their profits, and a lot of these contracts, the open interest, shrinks. At the same time, those holding calls, the 3,900 calls, they look at the tape, they see the SPX flushing down, and they say, you know what? We're not going to make it. So let's close these contracts at whatever value left in them or call it a day and say goodbye, go to the beach. And then what do you know? The dealer moves the tape higher above 3,900. And when that happens, whoever left holding these calls, the 3,900 calls, the value of their contracts deteriorated dramatically. So they book whatever profits they got, whatever losses they got, and those holding put options contracts at 3,900 and did not book earlier in the morning because they were too greedy, well, now either they're going to abandon their contracts or close them at a loss or whatever profits they got left. And then the dealer closes the tape at 3,900 or maybe a little above. And here's the beauty of this strategy. As the market is puking in the morning, the dealer buys shares of the SPX at below 3,900. So when they close the tape, if they do at 3,900 or above, whoever left holding the call options contracts for the 3,900 with the expiration date of Friday, the dealer has no problem right now delivering these shares to them at 3,900 because they bought them at a lower price. They're making profits. Now, is this clear? I hope that at least you got something out of this. I know I'm not really good at explaining things, but I gave it a shot. The bottom line is the dealer will either move the tape higher in the morning, then attempt to flush it down midday, and then close it flat, or the opposite. Flush it down in the morning, move it higher again, and then close it flat. This is what they're going to try to do, but a lot of things can go wrong. For example, if they flush the market down in the morning, and then we see a lot of folks rolling their put options down and out to further expiration dates, that will exacerbate the reverse gamma, aka the short gamma. We could see a massive flush down, where the SPX actually closes below 3,900 by a lot, and then the dealer ends up holding a massive bag because they have to buy all of these contracts at above 3,900. Likewise, if they roll the tape higher in the morning right away, and we see folks closing their shorts and folks rolling up in their call options and rolling to further expiration dates, the dealer will be forced to initiate a gamma squeeze and buy underlying shares of these options, and you can see the tape closing significantly higher. Keep that in mind. Now, before we move on to charts, let's identify the points of maximum pain for both the Qs and Apple, two important components. When we look at the Qs, these are calls for the expiration date of tomorrow. The point of maximum pain is the highest open interest that is closer to where the stock is trading right now. This point happens to be 290, with around 31,000 contracts open right now. When it comes to the puts, it's also the 290 with a stunning over 109,000 contracts open. So we know the bias is to the downside, but the dealer would love to close the Qs exactly at 290 or slightly above to make sure that the majority of these contracts expire worthless. When it comes to Apple, the point of maximum pain for calls is 150, with around 48,000 contracts open right now, and these are in the money. So if Apple closes above 150, the dealer is obligated to deliver shares of Apple at 150 to these contract holders. Even if Apple is trading at 160 tomorrow, they're going to have to buy it at 160, deliver it at 150. So they want the majority of these call options holders to lose their money by closing at or below 150. But here's the problem. When we look at puts, the point of maximum pain is also 150, with around 105,000 contracts open right now. So if they shake out the call options holders at 150 by closing below 150, the problem is they're now obligated to buy Apple at 150 to fulfill these open contracts for the puts at 150. And therefore, the dealer wants to create a shakeout operation. They go up in the morning, then they go down in the afternoon, and then they want to close flattish. Or they go down in the morning, then they go up again in the afternoon, and then close flattish. This is what they're aiming for. Whether they're going to be successful or not, that's a different story. But for now, let's move on to charts and identify some important support and resistance lines. We start with SPY, the S&P 500 30-minute chart. What's going on here? The most important line is 391, which is now resistance. The chart wanted to climb above 391 by the end of the day. It did not make it. Is it a rejection? Not really. We'll know that by tomorrow. But it's not a good sign that they did not make it above 391. And if they're going to go down further, we have support at 385. And here is the daily chart for the continuous contract for the SPY. The trend line is now gone. That's a bad sign for the bulls. The support line of 3,960 is gone. The next one would be 3,855. But the good news for the bulls, At least for now, they're not making a new lower low. They're holding the lows, at least for now. But the volume is against them, the momentum indicators are against them, but it's gonna get really ugly if we have a violation of 3,900 by a lot. Specifically on the SPX, the cash index, this is a weekly chart. What is the importance and the significance of 3,900? It is the last hope for the bulls, the reverse head and shoulder pattern. If they close the week below 3,900, the reverse head and shoulder hopes are gone. And for now, the likelihood is it's gonna be gone. Why? Because the volume is surging higher on down days. We have a negative divergence on the RSI. We have an imminent crossing to the downside in the MACD indicator. So for now, the bias is against the bulls. So they have a lot of work to do tomorrow in defending 3,900. The Qs, 30 minutes chart. What's going on here? The good news is the bulls are now holding 290 as support. The resistance at 294.33. Can they continue to hold at 290? Because if they don't, this is the point of maximum pain. We will see a flush down right away in the morning. What is the next support? The answer is I would go to the June bottom. I mean, we're getting closer, so might as well do it. Here's the daily chart for the continuous contract for the Nasdaq. The volume is not good. It's moving higher in down days. The momentum indicators are curling down. All of these are signs that the bears are in charge. The bulls lost 12,207 as support. We're now eyeing 11,689 as support. After that, we go down to the June bottom. And unlike the SPY, the Qs is actually making lower lows. So not a good sign here for the Qs. The IWM 30 minutes chart, Russell 2000, what's going on here? The outperformer today, believe it or not, and the bulls are placing their hopes that the IWM is a leading indicator that the pain that we saw in the S&P 500 and Nasdaq will be resolved to the upside tomorrow, because their leading indicator, the IWM, did not suffer the kind of pain that we saw in the previous two indices. For now, within range, the resistance is 183.25, support at 178.60. What about the most important chart to watch, which is the dollar index? Still holding above the trend line, still forming a bullish consolidation pattern, but it's not without risk. We have a negative divergence in the RSI. We have a crossing in the MACD indicator, a negative one that could accelerate anytime soon. And if that happens, the dollar goes down. And this is the only hope that the bulls got left. The dollar goes down. This will make the algorithms favorable for equities. And here is gold. What's going on with gold? Not a good look. It lost the important support of 1,685. The next support will be around the 1,600 territory. And here's crude oil, a daily chart for Brent. The bulls could not make it today, but I'm not saying they're dead, they're gone, because there is the potential for a higher low, which could produce the reverse head and shoulder formation. And this formation could take us above the sloping line of resistance once and for all. We're going to say that the bulls are gone here if they make a lower low, and specifically if they violate the important support of 85. And here's the daily chart for the 10-year yield. No update here, still within range, still holding at the resistance of 3.5%, but we're getting toppy. We're running out of time. It is just a matter of time before the 10-year moves down. Is it going to flush down because Jerome Powell will come out easy next week? Is it going to flush down for whatever other reason? That remains to be seen. Yet what's really important is the 2-year yield. And as you can see, it is blasting higher. And the next destination is, at least what the chart is eyeing right now, is 4%. Now, this contrast in performance, meaning the 2-year outperforming the 10, we see the 2-year moving higher, maybe the 10 moving down, is also known as the inversion of the yield curve, meaning indicating the severity of the recession. And for now, we have the worst yield curve inversion so far this century. So watch out here. And then we have the TLT weekly chart. What's going on here? We're not going to be optimistic on the TLT unless they close above 109.5 by tomorrow, the weekly closing. And here's the VIX 4 hours chart. What's going on here? The bull flag outlook still here. The momentum indicator is indicating positive momentum for the VIX. It is cooling off by a little bit for now, but we could see a resurgence tomorrow. And until and unless we see the VIX closing below 24.29, the bulls are not out of the woods yet. And here's Apple, a daily chart, could not make it at 157, didn't even try, and it's getting closer and closer to 150. If 150 is violated, the gates to hell will open, the sinkhole will open, and we will see a flush down. Now, if you show me this chart and you remove the tag, you don't say it's Apple, and you say, hey Maverick, what do you think about this chart? I would say it is negative. This chart's not good looking. This chart is going down to 138 at a minimum. And then you say, hey, this chart is for Apple. And that kind of changes things because this is the revered, the almighty Apple. Nobody wants to bet against it, but we're seeing more and more shorts betting against the name. And that kind of pressure will indeed be a self-fulfilling prophecy. Tesla, an hourly chart. What's going on here? The bulls, the gamma squeezers, whoever they are, doesn't matter. They got us all the way to close the gap, but they closed the tape below the gap. This is the bad news. The good news is they closed above 298. We'll see what's going to happen tomorrow because if the bulls abandon their positions, the gamma squeeze ends. We will see a flush down in Tesla. Why? Because the dealer doesn't need these shares anymore. They bought a lot of them during the gamma squeeze. Now they're no longer needed. If the bulls don't roll out and buy calls out of the money for a further expiration date. And lastly, tulips, Bitcoin. What's going on here in the 4 hours chart? Nothing is going on. We know that the momentum indicators are suppressed right now. They're due for a pop, but we're not going to bet for that outcome. And the reason is they're still trading below 20,000. They have to move it above 20,000 for any pop to happen. For now, Bitcoin remains dangerous. It remains in a period of the bulls, the bears making up their minds. It's a battlefield. I'd rather wait for who's going to prevail and then follow that trend. The bulls win, we follow the bulls. The bears win, we follow the bears. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the University of Michigan Consumer Sentiment Index, but all eyes will be on options expiration. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend.
Yes, those. I don't know what they are. You don't know what they are. Who gives a cash? Lots of cash are going to change hands inside a building that we have under AV surveillance close by.